Hey, how's it going, guys? Mark Anderson here, construction worker turned zero DT hedge fund manager. Today, I wanted to go over some backtesting principles, particularly with trading systematic strategies in regards to expected value. I've been getting a lot of questions on YouTube about, hey, what's your strategy? Can you share the strategy? So my strategies are all systematic and automated. And the backtest are effectively the strategy. I don't really live trade. I've only actually entered one order in the entire year on Interactive, and that was just to close out a order on August 5th because the bid ask was kind of wide. So these backtest really are my actual trading, but I want to run you through kind of a way to think of backtest and a way to protect against risk. So to basically start out with the kind of theory behind backtesting and being systematic is we start out with what is the expected value of a trade. So when we come down to what this is do we have an edge? And edge is basically defined as you being able to find a more accurate price in the marketplace than other participants. And then the second part to that is being able to protect against risk and protect against risk well enough that you can basically realize that edge in the long term. So to start out with price, a lot of people will have some type of crazy indicator or they'll be very much discretionary. And the first thing I would kind of like to highlight with that is when we're looking at systematic strategies, we want to use what is called the expected value equation. That's basically average win size minus average loss size is equal to, and then our win rate. So if we can affix our average win size, affix our average loss size, and then affix our win rate, we basically know we can establish edge. However, in markets, you can never affix all three variables basically because, occurrences are not linear, similar to people rolling a dice in a casino or such. So what we are in turn going to do when we're backtesting is we're going to choose to affix basically our average win size, which is our profit take, and our average loss size, which is our stop loss. And we're letting the variable be our win rate. Whereas when other people are discretionary, they can make their average profit size random because they don't know when to take the profit takes. They're going to use their average stop loss randomly because they change their sizing or they take their risk out at some, support or resistance. And then they kind of just try to force their hand on the win rate. And I think that's really doing a disservice to the ability to profit consistently over time. And people are relying more on talent rather than math. I would like to basically be the counterparty for that. So the first thing we need to determine is basically what is a fair price that in turn we can extract edge from. So the first thing here is you can see that we're selling a $15 put and we're just taking whatever the market price is. Clearly it has edge. For example, if basically why this has edge, we have an unlimited downside. It's not super capital efficient. We have a limited upside and, we don't have that much optionality. So whatever the market price is clearly a lot of edge. And what we've done here is, again, we fix our average win size and we fix our average loss size. We like to use delta because we want to do a percent probability. And basically an even more pronounced way to do this is instead of selling a one lot of 15 delta every single day, we could say, hey, we want to sell $500 in credit a day. So we may sell a 5 lot sometimes, we may sell a 7 lot sometimes. And basically this is just going to further drill down our average win size and our average loss size. And going back into the edge here is we can see that if we take the stop loss off, we now have a 51% capture and our P&L drastically goes up to 430,000. However, this works until it doesn't. Within 2020, we took a 20% drawdown. And this kind of shows how there's a lot of bull market geniuses out there that are taking a lot of risk. And you can see that it can work for a really long time, 1 year, 2 year, 3 year, 4 year, 5 year, before you finally get caught. And this person over here, who's much more responsible, definitely kept their drawdown to, only 2.9% here. It's just by far a much better way to go. And you're really thinking in the long term. And to further kind of show basically this is if you make 224 grand here and you have a 0.5 risk to reward ratio, and then here you make 430 grand and an 0.2 risk ratio, even though your capture is much more in this trade, you can in turn leverage it or maybe trade twice the size here. I also want to go into the concept here of when we're talking about stop losses. These obviously work until they do not. And kind of the whole point of stop losses is it's a way to shape the form of our distribution in a way we would like to see it similar to this. But when we're trading a trade similar to this, that is going to be illiquid overnight, we need to basically finance or purchase some type of black swan hedge to offset these types of drawdowns on gap risk. And this can also kind of be displayed here. If we go to trade log, we go to losers, you can basically start to see that, our losers are relatively consistent. But if we go to maybe 2020 here, we can see that, we take some rather drastic losses on fixed one lots of $1,200, $1,300. And those are obviously not very attractive to do. And the other thing, now that we've kind of gotten this down, and I think everyone agrees that we want to follow that expected value equation, is when we're going back to edge, I want to talk about the power of small edges. So if we were to look at this trade with a filter, you can see that this takes 2,200 trades. We're just using the 200-day SMA, and this takes 2,700 trades. And in regards to this, we are getting a higher capture, and we are taking 80% of the trades. And in turn, we get 80% of the profit. So it's kind of weird how that basically balances out to the exact same that if we were to just take it every day, even though the capture is lower. So what people often mistake is you will use some type of filter. And when you use that filter, it provides you with more of an edge. However, since you're excluding some equations from the data set, you in turn now make it more difficult, or there's going to be more variables in order to basically reach that edge. And to extrapolate that into numbers a little more, if you have a smaller edge, but you can create more occurrences with that edge, and also if you don't exclude any occurrences, you're going to be much more likely to actually meet your expected return. All of a sudden, 26% capture with 2,700 trades and 224 grand. Then we have 80% of the trades, 2,200 trades with a slightly better capture, yet we still have 80% of the P&L. So you can kind of see on a larger scale, this goes back in the Shannon-Demon thought of basically how that is able to benefit you even more. Now that we've kind of gone through the expected value equation of average win size, average loss size, if we're going to use filters or not, we can go back to the thought of basically protecting against that risk and in turn that black swan risk. So the stop loss is great again because it can form the shape of our distribution, but when the unknown happens, we need a way to hedge against it. So here's an example of potentially an offsetting hedge, which is selling $1 with a profit take at 1,000% basically. You can see that we have a little bit of positive expected value. However, it only hits 1, 2, 3, 4 times basically in the history of this trade. So something that is this infrequent can be rather concerning. And the other thing, as someone that has personally traded this, is if we go to the winners, we can see that all the winners hit at 9:32 a.m. And I can say that at that time, it's actually relatively hard to monetize these trades, and you don't necessarily know what they're going to look like. So to further kind of display this, which may not be the most easing thing on earth, is let's find an option that's much more accurately priced. You could see here when this option is profit take for $40, it was at a 3,500 strike, whereas the market was at 5,100. I've never seen $40 premium on a trade like that. That's $200 out of the money, or, roughly, 5.5% of the index value or something. Now, if we were to go to $5, you can see that all of a sudden this no longer really works. Whereas if we look at this trade, which is a 4,300 strike, and now you're getting, $100, it's still at 9:32 a.m., it may be a little more believable. So I just wanted to show you that we need to hedge away that ultimate risk. There may be more responsible ways to do it, but when we go into hedging, we need to think of hedging as taking an offsetting position that basically allows you to protect against risk more. We can see that when we're hedging this, it's very risky if it'll actually work. I don't trust this back test, whatever, because $1 is super far to the money. And even though it may have marked at this in the back test, I don't think it would have been able to monetize it, especially since it was longer in duration. And if an option is closer to the money, you think it would, be a more accurate price and would be able to monetize it easier. And you can see here that doesn't work quite as well. So when we go back to the thought of hedging, is how do I protect against this risk of taking an offsetting position to reduce that. The simplest answer, other than using on these hedges that only have 4 monetizations over a decade, and we may not be able to actually count on that, is to simply just lower your size, because by taking a smaller size, you therefore diversify away from that risk, and you're taking an offsetting position by just trading smaller to reduce your risk. The way I would recommend run this, I know this sounds kind of ridiculous, but if you run it at 10 basis points a week, that would basically be selling 5% of your account in premium a year, and you'd basically be taking, a 1% return on it. So maybe that's responsible, or maybe you could double or triple that, and I think it could still be responsible. But the sizing is really the best hedge, and you can see the flaws with trying to monetize for hedge. And something that I like to highlight is it's this thing called dragnet theory, or some fishermen, they just drag a net on the bottom of the ocean surface to grab whatever may be in there. This is a different source of edge because it's predominantly, based on implied volatility and longer duration vega. However, it's very hard to trade in size or protect against risk, and it works until it doesn't. And this is what most bull market geniuses are doing by trading high beta stocks. So when we're doing this, if we run it at a 3 to 5% annual target, and then we stack some 0 DT on it, we stack some 7 DT hedges on it that have a positive value, we stack some long calls on it, and we maybe stack some core like holding of SPY, all of a sudden we have more diverse cases of edge, and we could profit more from different sources. And their size so trivially small, all these different sources of profit, that all of a sudden, even if you don't make money in a year, like in 2022, there could be other trades that did well in this year. And since drawdown is only 3%, just from the fact that this is a diverse source of edge and other trades work when others are not, you can still have a better portfolio return with the sum of the parts while losing money on a trade. This, is a little information. I just wanted to give you guys a different take on backtest of the week and kind of some best practices. So if you guys have any other particular questions, drop them below. If there's a backtest that you would like me to cover, feel free to drop in options of Megalink, and I will go over it next week. Also, if you guys could share this, it's the highest compliment to me and allows me to do more. Appreciate you guys for listening. I will talk to you soon.